Hello and welcome back to Boni's Life, your home for deep intellectual and fact-based analysis of the financial world. If you're feeling a bit of whiplash from the crypto markets this week, you are not alone. We've just witnessed one of the most brutal, gut-wrenching corrections in recent memory. Bitcoin, after teasing us with highs above $126,000 just last month, came crashing down, slicing through the psychological $100,000 barrier and plunging to levels we haven't seen since May. Over $1 billion in leverage bets were wiped out in a single day, and fear has gripped the market. But amidst this sea of red, a fascinating and deeply important story is unfolding. While the price charts scream panic, the fundamental landscape of cryptocurrency has arguably never been stronger. We're seeing historic regulatory progress in the United States Senate, the launch of a groundbreaking new ETF, and unwavering conviction from some of the biggest players in the space. So, what is the truth? Is this the start of a new crypto winter? Or is this the generational buying opportunity that market legends are made of? In today's deep dive episode, we are going to cut through the noise. We will dissect the anatomy of this crash, linking it to global macroeconomic forces. We'll analyze the moves of crypto leaders like Saylor and Vitalik Buterin. We will unpack the landmark regulatory developments that could change everything for this industry. And most importantly, we will dive deep into the technical indicators to give you actionable strategies and key triggers to watch for over the next 24 hours. This is not the time for panic. It's the time for clarity. Let's get into it. To understand where we are going, we must first understand what just happened. This wasn't a random event. It was a perfect storm. A confluence of powerful forces that hit the market with brutal efficiency. Let's break down the three main drivers of this crash. First, we have the macroeconomic headwinds. The global financial system is a complex interconnected web, and cryptocurrency is no longer an isolated island. On November 14th, troubling economic data emerged from China. Industrial production slowed dramatically to 4.9% year over year, a significant drop from the 6.5% seen in September. Even more concerning, fixed asset investment contracted by 1.7% over the first 10 months of the year, a historic slump. This data sent a chill through Asian equity markets, with the MSCI Asia Pacific Index dropping 1.3% within minutes. That weakness spilled over into crypto, confirming a pattern we've seen throughout this quarter. Digital assets are behaving like high beta risk assets, highly sensitive to global economic sentiment. Compounding this was a shift in expectations from the US Federal Reserve. Hopes for a December interest rate cut, which had been fueling market optimism, began to fade. A series of cautious remarks from Fed officials led money markets to price the odds of a December cut at below 50%, a sharp reversal from earlier in the week. With the prospect of cheaper money disappearing, investors began to de-risk their portfolios, and the most speculative assets, including crypto, were the first to be sold off. Second, we have the internal market structure. The conditions were ripe for a cascade of liquidations. Before the crash, funding rates across major cryptocurrencies had turned positive, meaning traders were paying a premium to hold long positions. Open interest in futures contracts was climbing, indicating a high degree of leverage in the system. At the same time, spot trading volumes were thinning out. This created a fragile, over-leveraged market. When the macro news hit and the price started to fall, it triggered a domino effect. As prices dropped, leveraged long positions were automatically sold off, pushing prices down further, which in turn triggered more liquidations. This is the liquidation cascade that wiped out over $1.1 billion in just 24 hours. According to data from CoinGlass, a staggering $887 million of that came from bullish long positions. Over 235,000 traders were forced out of their positions, with the single largest wipeout being a $44 million Bitcoin long on the HTX exchange. This wasn't just selling, it was a forced violent unwinding of speculative excess. Third, and finally, we have the technical breakdown. The $100,000 level for Bitcoin was not just a number, it was a critical psychological and technical support level. Once that level was breached, it created a vacuum. The price sliced through the $98,000 support level with ease, and liquidity pockets on the way down evaporated, accelerating the move towards the $95,000 region. This technical failure signaled to traders that the bears were in control, adding fuel to the fire. So, to summarize, we had a potent cocktail of negative macroeconomic news, a fragile and over-leveraged internal market structure, and a critical technical breakdown. This wasn't just a correction, it was a market flush out, a painful but perhaps necessary reset. Now, let's look at how the key players in the crypto world reacted to this chaos. Now, if you only looked at the price charts, you would assume the entire crypto world is in a state of panic. But when you pull back the curtain, you find a completely different story. While the market was bleeding, some of the most influential figures in the space were not only holding their ground, but doubling down on their convictions. This creates a fascinating tale of two narratives: the short-term panic versus the long-term fundamental strength. Let's start with the ultimate Bitcoin bull, Michael Saylor. As the market was tumbling, what was his company MicroStrategy doing? Panicking? Selling? Not a chance. On November 10th, with Bitcoin's price wobbling, Saylor's company filed with the SEC to announce they had purchased another 487 Bitcoin for approximately $50 million, at an average price of over $102,000 per coin. This brought their total holdings to a staggering 641,692 Bitcoin, a treasury worth over $67 billion at the time. This wasn't a one-off purchase, it was a continuation of a relentless accumulation strategy. Their average cost basis for all their Bitcoin is around $74,000, meaning even with this recent crash, they are still sitting on an unrealized gain of over 38%. Saylor's actions speak louder than any market commentary. While others see volatility, he sees opportunity. His public statements reinforce this conviction. On November 11th, as fear was peaking, he posted a simple, powerful message on Twitter. First, get the Bitcoin. He has consistently urged investors to remain faithful amid the turbulence and has reiterated his belief that Bitcoin will eventually surpass gold's market cap by 2035, thanks to its fixed supply and tightening production schedule. This isn't just talk, it's a multi-billion-dollar bet on the future of digital property. The market is even starting to recognize this conviction. Kynikos Associates, a well-known short-selling firm, recently announced it had closed its short position against MicroStrategy's stock, a sign that even the skeptics are starting to reconsider betting against Saylor's Bitcoin strategy. While Saylor focuses on Bitcoin as the ultimate store of value, Ethereum's co-founder Vitalik Buterin is painting a picture of a rapidly maturing ecosystem of decentralized applications. In a pre-recorded address on November 13th, Buterin declared that DeFi, or decentralized finance, has reached a turning point. He stated, and I quote, "DeFi as a form of savings is finally viable." He envisions a future where people and institutions use DeFi protocols as their primary bank accounts. He acknowledged that the journey has been rocky, with hacks and exploits, but argued that the difference between the DeFi of today and the Wild West of 2019 is night and day. And the numbers back him up. The Ethereum DeFi ecosystem is now processing over $1.9 trillion in transactions per quarter, with a market size of $77 billion and over 312 million active users. Average DeFi savings yields are hovering around 8.2%, compared to just 2.1% in traditional banking. Buterin also highlighted significant technical progress, with new scaling solutions like the Lighter tool achieving over 10,000 transactions per second. This is not the slow, expensive Ethereum of the past. This is a network that is rapidly evolving to handle real-world demand. So on one hand, we have Michael Saylor, the institutional titan, relentlessly accumulating Bitcoin as a pristine collateral asset. On the other, we have Vitalik Buterin, the visionary builder, pointing to a burgeoning ecosystem of financial applications that are becoming safer, faster, and more user-friendly. These two narratives are not contradictory, they are complementary. They paint a picture of a technology that is maturing on multiple fronts, even as its price experiences wild swings. This fundamental strength is the bedrock that long-term investors are standing on, and it brings us to the most significant development of the past week: a potential end to the regulatory chaos in the United States. For years, the biggest obstacle to mass institutional adoption of crypto in the United States has been the lack of regulatory clarity. Companies have been caught in a tug-of-war between the SEC and the CFTC, unsure of which rules to follow, but that may be about to change. On November 11th, the Senate Agriculture Committee released a bipartisan discussion draft of a new digital assets market structure bill. This isn't just another press release. This is, and I quote the CEO of the Digital Chamber, the most consequential roadmap for how an institution is going to integrate digital assets into their business. Let's break down the 5 key takeaways from this landmark bill. First, and most importantly, it grants favorable regulatory status to Bitcoin and Ethereum, classifying them as digital commodities. This would officially place them under the jurisdiction of the Commodity Futures Trading Commission, or CFTC. This is a huge deal. It removes a massive blocker for institutional fiduciaries who will finally have a federal statute to point to. This provides the legal certainty required to move from speculative bets to formal strategic allocations in their portfolios. Second, the bill requires crypto firms to segregate their funds and manage conflicts of interest. It challenges the all-in-one business model common among crypto exchanges, where the exchange, broker, custodian, and trading desk are all under one roof. This would force crypto companies to operate more like traditional financial institutions, a foundational pillar for institutional trust. Third, the bill gives the CFTC more power to regulate digital assets, empowering it to work alongside the SEC to issue joint rulemaking. This signals a shift in power away from the SEC, which has taken a more aggressive and some would argue hostile stance towards the industry. Fourth, the bill allows the CFTC to collect fees from regulated entities to fund its oversight. This is a sign of a maturing industry, contributing to its own regulation. And fifth, it establishes strict listing standards for tokens, requiring exchanges to only permit trading of digital commodities that are not readily susceptible to manipulation. This is a direct shot at the thousands of scam coins and rug pulls that have plagued the industry, and it's a crucial step towards building confidence in the market. Now, this bill is still a draft. It will likely take months to finalize and pass, but it provides a clear roadmap for where Congress is heading. And while this was happening, another historic event took place. On November 13th, the very first US spot XRP ETF, issued by Canary Capital under the ticker XRPC, began trading. This follows the successful launch of Bitcoin and Ethereum ETFs and opens the door for another major digital asset to be accessed by a wider range of investors through traditional brokerage accounts. Despite the market crash, XRP rallied on the news, demonstrating the power of regulatory progress. What we are witnessing is the slow, methodical, but undeniable integration of digital assets into the mainstream financial system. The Wild West days are coming to an end, and while this transition may be volatile, it is fundamentally bullish for the long-term health and adoption of the industry. Now, with that crucial context in mind, let's turn to the charts and see what the technicals are telling us about the immediate future. All right, we've covered the macro, the fundamental, and the regulatory. Now, it's time to get our hands dirty with the technicals. For traders, this is where the rubber meets the road. The charts tell a story of fear, but they also reveal key levels and potential opportunities. Let's break down what the indicators are telling us right now based on the latest data. First, let's look at the moving averages, the backbone of trend analysis. The price of Bitcoin is currently trading significantly below both its 20-day and 50-day simple moving averages. The 20-day SMA is sitting around $106,700, and the 50-day is even higher at about $111,200. This is a classic bearish signal. It tells us that the short-term and medium-term trends are pointing downwards. Furthermore, we have a bearish cross configuration, where the shorter-term average is below the longer-term average, reinforcing the strength of this downtrend. Next, we have the MACD, or moving average convergence divergence, which helps us gauge momentum. The MACD line has crossed below the signal line, which is a bearish signal. More importantly, the MACD histogram is negative and expanding, which means the downward momentum is not just present, it's strengthening. This tells us that sellers are still in firm control and the downward pressure is intensifying, not easing up. Now, let's look at the Relative Strength Index, or RSI. The RSI is currently at about 35. This is in neutral territory, but it's falling and rapidly approaching the oversold threshold of 30. An asset is considered oversold when the RSI drops below 30, which can often signal that a price bounce is imminent as the selling becomes exhausted. We are not there yet, which suggests there could be more room to the downside before we see a significant reversal. This is a critical indicator to watch over the next 24 hours. Let's move on to the Bollinger Bands. The price is currently hovering in the lower half of the bands, approaching the lower band, which is sitting around $97,400. The lower Bollinger Band often acts as a dynamic support level. A touch of this band could provide a temporary floor for the price and lead to a short-term bounce. However, a sustained break below this lower band would be a very bearish sign, indicating extreme selling pressure. Finally, let's talk about volume. The volume analysis is perhaps one of the most telling indicators right now. We are seeing significantly high trading volume on down days. The current 24-hour volume is nearly 60% higher than the 20-day average. This high volume confirms the strength of the selling pressure. It shows that there is strong conviction behind this downward move. We have not yet seen a massive climactic volume spike that often marks a market bottom. This suggests that while we are in a deep correction, the final capitulation may not have happened yet. So, what does this all mean for your trading strategy over the next 24 to 48 hours? Let's synthesize this into clear, actionable triggers. For a bullish scenario, here are the triggers you need to watch for. Number 1. Price action. We need to see a strong bounce from the support zone of $94,000 to $95,000, confirmed by high buying volume. Number 2, RSI. The RSI needs to dip below 30 into oversold territory and then reverse. Crossing back above 30, this would signal that the selling is exhausted. Number 3, MACD. The MACD histogram needs to stop expanding and start contracting even while negative. This would be the first sign that downward momentum is weakening. If these triggers are hit, a potential entry could be in the $94,000 to $97,000 range, with an initial target of $100,000 and a secondary target of $105,000. A stop loss should be placed below $92,000 to protect against further downside. For a bearish scenario, the triggers are: number 1, price action. A clean break and close below the critical support level of $94,000 with high volume. Number 2, RSI. The RSI continues to fall without any sign of a bounce, even below 30. Number 3, volume. We see sustained high volume on down days, indicating that sellers are not letting up. If these bearish triggers are hit, it would be wise to avoid new long positions. The next major support level to watch would be in the $88,000 to $90,000 range. A break below $85,000 would, for many analysts, confirm a new bear market. Given the high volatility, here are a few strategies depending on your risk tolerance. For the conservative investor, dollar cost averaging, or DCA, is your best friend. Continue your regular weekly or monthly buys. This removes emotion and allows you to accumulate at lower prices. For the active trader, consider waiting for a clear reversal confirmation. This means waiting for the price to reclaim a key level, like $100,000, or for the RSI to show a clear bullish divergence. This is a more patient approach that waits for a higher probability setup. For the risk taker, buying at key support levels can be profitable, but it's risky. If you choose this path, use tight stop losses and consider scaling into your position at different levels. For example, at $94,000, $90,000, and $85,000. No matter your strategy, risk management is paramount. Never invest more than you can afford to lose. Use stop losses and keep some capital in stablecoins to take advantage of opportunities. This is a time for strategic thinking, not emotional reactions. So, we return to our initial question: is this a market bloodbath or a generational buying opportunity? The honest intellectual answer is that it is both for the over-leveraged, short-term speculator. This has been a bloodbath, a painful lesson in risk management. But for the long-term, fundamentally driven investor, this correction is looking more and more like a significant opportunity. The market is currently caught between powerful bearish technicals and incredibly strong bullish fundamentals. The short-term trend is undeniably down, and we may see more pain before we find a bottom. However, the long-term picture is being painted by the relentless accumulation from institutions like MicroStrategy and the landmark regulatory progress being made in Washington. The foundation of the digital asset economy is being solidified brick by brick. My final recommendation is this: exercise patience and discipline. The market is giving you a gift, the gift of time. Time to research, time to plan, and time to accumulate at prices we might not see again for a long time. Watch the key levels we discussed, respect the bearish trend, but be prepared for the bullish reversal. The road ahead will be choppy, but for those who can navigate these waters with a clear head and a steady hand, the destination looks brighter than ever. Thank you for joining me on this deep dive. If you found this analysis valuable, please like, subscribe, and hit that notification bell so you don't miss our next episode. And as always, I want to hear from you. What are your thoughts on this crash? Are you buying, selling, or holding? Let me know in the comments below. Stay safe, stay informed, and I'll see you next time on Boni's Life.